U.S. stocks kind of wobbled on Friday. The session was volatile with mixed results, but for the week, all three indices ended with losses for the first time this year. The markets have seen choppy price action over the past week after the Federal Reserve raised its short-term interest rate by a quarter point. And data from Bespoke Investments on Friday showed that most sectors are trading on the downside, excluding energy, which has rallied. On the macro front, the University of Michigan's Consumer Sentiment Index rose to 66.4 in February, and this is the highest level since January of 2021 and may reflect the recent jobs numbers. Meanwhile, low liquidity in the markets pushed a move in bonds as the bond market is repricing higher terminal rates from the Fed and perhaps fewer rate cuts in the second half of 2023, and this after last week's hot jobs report and the expected Fedspeak. The yield on the 10-year U.S. Treasury note ticked up to 3.74%. Normally, we would be looking at the S&P 500, but for this update, we're going to look exclusively at interest rates. Now to look at interest rates, I go to Big Charts, which is a market watch product. Again, bigcharts.com. And you're looking at the chart right now. We only have a few oscillators, but that's all we really need. Now, the complex part about it is in the upper left. The symbol for the 10-year Treasury note is BX colon TMU BMUSD 10Y. Again, this is the U.S. 10-year Treasury note. Now, we're looking at a 2-year weekly chart, and as you can see here, from this low, we've come up in a stair-step fashion all the way up here to peak above 4.25. Now we've come on down here, and we're consolidating, and it looks like it wants to make another move on the way up. You come down here into the oscillators. We show here the MAC, then the slow stochastics, and then the Williams. So looking at the MAC, here the fast line is in blue and the slow line is in red. So the fast line looks like it wants to bottom and base here, and I'm expecting it to move up and through the slow line or the red line, moving on up. And you can see here in the histogram, it shows this pattern with the attempt upward here that failed, got rejected, back down, and we're closing in again on another attempt. Down into the slow stochastics, you can see that we had this move, rejected, came down here, it's at a higher level, so it's gaining strength, and it's want to go up here, back up to this, say, 90 level, and that would bring the fast line up and through the slow line on the MAC. Down here in the Williams is also showing that it's making its move on up. So that's the greatest probability, is a fast line coming on up and through here. So back up to the chart, and what we want to look for is that move coming here within the next few weeks or so, and that would make this a W formation down here, back on up, back on down, and then the move back on up if that's what happens. And that's, I think, again, the greatest possibility. I'd like to see it move on up. I think it's going to test the 4 to 4 1/4 level here. We might get a double top. So let's go ahead and take a look at a longer chart and see a potential double top. So now we're looking at a longer term chart, and this is the all data monthly chart, and it goes back to about 2007, about as far back as we can go. But certainly you can see that rates back in 2007, 2008 were much higher, and then because of the great financial crisis came on down, and then subsequent events we came on down even further, all the way down to 0.5% here. Now, After a couple of years, we've made it all the way up and above 4.25, and that's a huge move, even though it took a couple of years to get there. That's a huge move, and I think interest rates are nearing an exhaustion point. But as I said in the previous chart, I'm going to be looking for a double top. If we do head up to 4.25 and higher, then again it's a new ball game. But I'm going to be looking for a double top somewhere between the 4 and 4.25, and we'll see that perhaps in the next month. It might take a little bit longer, but that's kind of my pinpoint at this time. And if we hit a double top and this rolls over and interest rates head on down, that could be a new ball game for the stock market. The stock market would get some relief and head on up. Now you look at these tops of these previous highs, and it doesn't spend too much time up there before it heads on down. So it's possible we could continue coming on down, but I'm looking for that double top here. But overall, I think the probability is that interest rates will roll over, I would say, within the next few months, perhaps not much longer than a quarter. Moving down here, you see the oscillators, you see the MAC. The MAC up at this level here is the highest it's been, going all the way back to 2007. So I'm looking for this to roll over. The histogram here in the black, these black bars, you can see that it's starting to close the separation between the fast line and the slow line. So to me, the probability of the fast line coming down and through the slow line and heading on down is greater. Moving here into the stochastics, you can see here it spent a couple of years up here. Going back, it was up here, these two tops, for a couple of years, but beyond that, it doesn't spend too much time. So that's another reason that I'm thinking that the oscillators are showing signs of exhaustion. Same thing here in the Williams. This probably does it even better than the other oscillators. It's been above that, say, mid or 50 level for 2 years or over. So I think it's about time that we're going to head on down. One last look at the price chart, and you can take a look here. My bet is the probabilities we're going to be heading on down. No guarantees, just keep your eyes on it. And for today, that's ChewDog Charts. Thank you.